in many cases, this continues to resemble the 1940s, and I think we're probably still in the early 1940s. The war's not over yet. This is not like 1945, 1946. This is like, wave one, I think, of this dilemma.
Lyn Alden is one of the best rising macro analysts and the founder of the multi-million-dollar Lyn Alden investment research firm. In today's highlight, Lyn performs a clear, coherent analysis of all of the seemingly unrelated contributing factors that are all working harmoniously to create the disastrous state of the US government bond market. After watching the video, you'll understand all the unique combinations of forces that are driving the worst US government bond crisis we have seen since World War II. If your financial planner has you on the standard 60-40 portfolio, look out.
And it's funny, I've been a bond bear, right? So I remember like last year I would go on multiple interviews and explain why I don't like bonds. Primarily my focus was on real terms. I was like, I'm not even sure what yields are going to do, but especially in an inflation adjusted sense, I don't like bonds. They've done even worse than I would have guessed. So they've hit higher nominal yields, much worse price sell-offs than I would have guessed a year ago. Despite being a bond bear, I've not been bearish enough on bonds. And so I would say the extreme of some of the moves. So the surge in the dollar, the surge in the yields, the war in Europe, some of these kind of the extreme levels of the moves, I think would say has surprised me to some degree.
So we've got a chart here, and the more extreme decline in purple is the global Bloomberg Aggregate Bond Index. Orange is U.S. bonds, and again, the dollar's been strong, so the pain has been not as acute there. Why do you think yields have sold off so much?
The short answer is inflation. I started writing about bonds back in 2019, in some cases a little bit earlier, and I had an article in the middle of that year basically saying, are we in a bond bubble? And I went through the whole thing where, we had, $18 trillion in negative yielding debt out there. Magazine covers were saying inflation's dead. And I kind of reviewed this whole possible thing. I was like, inflation is something that in extreme environments, fiscal and monetary authorities, especially when working together, can generate, quite well if they get to the point where they need to. And, we got the catalyst the next year in 2020. And ever since then, we've been off to the races in terms of the amount of monetary expansion, at the broad layer, not just base money, but broad money expansion, more money in people's pockets. Then combined with various inflationary forces like an energy crisis and kind of a reversal of some of these offshoring globalization trends, which keeps downward pressure on labor prices domestically. And so when bonds are yielding next to nothing and inflation is reaching 4-decade highs, I think it's natural for those yields to want to push up because they're, even after this crazy sell-off, those yields are still below at least current inflation. Now they're above forward inflation expectations, but forward inflation expectations has not been particularly accurate in recent years. I think it's a combination of one, trying to deal with the inflation, and two, some of it's mechanical. Some of it is, as central banks are trying to fight that inflation, they're trying to not buy as many bonds or even let some bonds mature off their balance sheet. And so now you have basically oversupply of bonds, large deficits, and then you have some of the biggest buyers not selling, not buying. And then when you go to some markets, like for example, the US Treasury market, foreign countries use those treasuries as like a ballast for their own currencies. So when the dollar is weak, they're generally accumulating treasuries. And when the dollar is very, very strong, like it is now, especially compared to many other developed market currencies, so ironically, some of the emerging markets are actually holding up better. But the dollar is very strong relative to a lot of these other currencies. And so what they do is, first they stop buying treasuries. And then two, they can start letting treasuries mature off their balance sheet. They can sell some of the shorter duration stuff that they have. And, if it gets bad enough, they could even sell some of the long duration treasuries. And so you have a lack of a foreign bid for treasuries. And so basically in this environment, it's a very toxic combination for the sovereign bond market.
How would you evaluate the bond market's track record over the past, let's say, 3 years for forecasting growth and inflation?
I would say, it's like an F. It's failed. The bond markets, equities, if anything, have been more accurate than bonds in the past few years. And I think that's kind of common at major trend shifts, right? So, you had 40 years of kind of structural disinflation. And you had periods of inflation in there, like the 2000s decade, but you still had a structural disinflationary trend. So we had structurally falling interest rates, higher and higher debt relative to GDP, globalization. A lot of these were these, disinflationary forces. Aging demographics, for example, in some cases can be disinflationary. There's actually some nuance there that they actually can be inflationary in some cases. But we had a 40-year period of kind of like the great normalization, the great disinflation.
Coming next, Lyn makes a shocking comparison of today's market conditions to the 1940s and how we can use that scenario to predict what's to come in the next few years. As we move on to part 2, hit the like, subscribe and bell button to get immediate notification of tomorrow's video, where Robert Kiyosaki and Todd Seidel reveal how retirement funds around the world are vulnerable to collapse and what you need to do to protect yours.
The type of inflation we had this time is quite different than the 1970s inflation. So a lot of people that were kind of, when they were determining whether or not inflation is going to happen, they were looking at the 1970s and saying, well, we don't have those conditions, so why would we get inflation? And it's like, well, go back to the 40s and you'll see why we were going to get inflation. And so that was, in my view, the 1940s were the closest analog. And the big difference there is that in the 1970s, inflation was in large part coming from peak demographics. So baby boomers entering the workforce, buying tons of homes, a lot of banks lending, and therefore a lot of money supply growth from banks lending. And a lot of people said, none of that's happening, so we can't get inflation. And it's like, well, the other level of inflation is like the 1940 style inflation, where you have absolutely massive government deficits that are monetized and supported by the central bank. It pours money into the economy, goes around the banking system, or in Russell Napier's view, it supports the banking system, but you can also just go around them pretty much, and it just puts more money in people's pockets, and then you add it's basically wartime finance. And so in 2020 and 2021, we had wartime finance in response to lockdowns and things like that. Basically, if you just showed me charts what was happening, it looks like a war. And of course, now we have actual war, which is also inflationary because it's malinvestment. It adds frictions, it reduces productivity, it reduces global efficiency, and so this is a very inflationary cocktail. In many cases, this continues to resemble the 1940s, and I think we're probably still in the early 1940s. If anything, I think we're still, the war's not over yet, right? So this is not like 1945, 1946. This is like, wave one, I think, of this dilemma. I think the war ends when the energy supply situation is more resolved and some of these geopolitical things are more resolved. And then probably also when you've inflated quite a bit of the debt away, which is, I think, we're nowhere near doing. For the first couple of years here, that we've been kind of running the 1940s playbook pretty closely. Now, kind of Powell doesn't want to be the fall guy for this, right? So now he's trying to run the 1970s playbook. But the problem is that when Volcker did that playbook, the United States has 30% federal debt to GDP, and lower private debt to GDP. And, by the time you got to the end of the 1970s, you resolved a lot of the underlying energy supply shortages, right? So it wasn't just Volcker gets all the credit, but it was also those underlying forces were more resolved, right? And so the problem now is that, basically, is there any relief structurally on the energy supply side over the next few years? And I would say no. There's not a ramp up in capex. There's short-term band-aids. So, for example, the current administration is drawing down the Strategic Petroleum Reserve to add excess supply. China has been doing rolling lockdowns for 2-3 years now, and so they've been below normal flight capacity, driving capacity. So they're reducing their fuel usage. So we have these kind of like forces that are kind of keeping the lid on energy to some extent, at least outside of Europe. And the problem is that a lot of those are kind of temporary, and it's only resolvable by actual new supply coming online, and that's not really happening. And then ironically, by raising rates, you suppress demand to some degree, but you also increase the cost of capital for those energy companies, and so the hurdle rate for their investment, especially in longer term projects, is now higher. The question I've been asking is, what's step two, right? So step one is hold the beach ball underwater, suppress demand, hold this down, and then okay, so let's say you're successful. You've caused a recession, you've crushed frontier markets. Everybody believes you're going to be a hawk. Now what, right? So when you ever want to reaccelerate, you ever want to grow again, you let that beach ball go, and then energy supply problems still here. That's not, it hasn't been solved. And so the beach ball pops back up again. So much like in the 70s, you had rolling inflation. In the 1940s, you also had, spikes in inflation. Then you even had periods of deflation because partially you had price and wage controls. Partially there's underlying just volatile changes that are happening during that decade. It's not just a straight line up of inflation. And so I think the 2020 is going to be similar, which is, no playbook follows the exact playbook, but essentially we are in the Empire Strikes Back phase now, where they're trying to gain some control of this. But my kind of focus is, what is step two? How do you fix the energy supply side? Because I think until that's solved, inflation is going to be ready to come around. And so until then, you're choosing between, kind of recessionary-like conditions, either outright recession or might as well be a recession, or you're picking high inflation. And I think eventually, treasury market breaks, they have to get back to higher inflation, but that can take time because the treasury market is more resilient than a number of other sovereign bond markets. So right now, if you look at the treasury market, it's near record levels of illiquidity. It's near record levels of volatility. And then the question is, how long can that persist, right? So if the dollar takes a break, if rates take a break, for example, maybe the foreign sector stops trimming their holdings, and maybe that can stabilize. On the other hand, if you keep pushing that really hard, if you keep, raising rates, if you keep quantitative tightening, if you keep, strengthening the dollar, and then all those other countries keep trimming their holdings or not buying or letting bonds mature off their balance sheet, that kind of thing, that puts more and more pressure on the treasury market. And so there's a variety of tools they can do. One is outside of the Fed, the Treasury Department can come in and they can do, they can do buybacks. They can buy off the run securities. They can issue more T-bills. And so when you ask the question of where's the balance sheet capacity to buy treasuries, one of the answers is reverse repo, right? But it only works for shorter duration stuff. And so there's a way to get liquidity out of there and into T-bills, but that's effectively lowering the average duration of treasury debt if they do that. But that's an option that they have to extend this. Another option is that the Fed, they have repo programs in place. They could do kind of their own sort of Operation Twist or their own sort of targeted periods of time of QE if something breaks, while still keeping rates where they are. So that they have a variety of tools to, I think assist the treasury market if it does get to the point where they need to assist it. And you can kind of be tightening on one hand and loosening on the other. And so that can still be like a net liquidity add while you still have the optics of being tight. So I think that's probably the highest probability. You can also do things like SLR adjustments so that you have the banking system buy more of the treasuries. And actually, if you go back to the 1940s, so right now the banking system in the United States has a bigger percentage of their assets are treasuries than any time in modern history. If you go back far enough, though, the 1940s and shortly thereafter, they had even a higher allocation of treasuries. So, during that whole war era, the Fed did a lot of the initial financing. They increased their treasury holdings by like 10x between like 1942 and 1945. But then after that, a lot of it was bank financing. And so, there's tools to then put that on the banking side. That has political ramifications, right? There's some politicians that would not be thrilled with that. And so there's a bunch of different levers that they can pull while still retaining some degree of tightness or tight for certain things, loose for other things. Essentially tight for the private sector, but you can loosen a little bit for the public sector. And so that's something that we've not really seen over the past decade, but that you started to see, for example, Bank of England was an example of that. Higher rates, but then some degree of QE for the sovereign bond market.
Check out this video to find out why Jim Rogers thinks the next recession will be the biggest he's ever seen and where you can invest so you don't take the fall.